So let's continue our discussion on bonds, especially the relationship between interest rates and bonds, and then we'll get into zero coupon bonds in this concept video as well. So one important thing to realize is interest rates greatly affect bond prices. When interest rates change, that changes the bond prices, and there's a definite relationship between interest rates and bonds. And so when the Fed, for example, raises rates or lowers rates, um, the whole bond market will shift and things will reprice. And there's a whole market for this. And there's a term structure and the yield curve that tracks all this movement. So bonds prices change because most of the issuers of the bonds choose a coupon rate so that the bonds initially would trade right at par. And par value means like same as the bond price. It's not if the face value is 1,000, they want to charge close to 1,000 as they can, right? But changes in the market interest rates affects the bond's yield to maturity. So think about it this way: you invest in a 5-year bond, and so your money is locked up, you know, for 5 years. And as interest rates may fluctuate, your money is still stuck there. And so as they continue to sell the bonds, they have to adjust these prices to make it more attractive um, for people to buy them. So, for example, if the interest rates were 5% for your 5-year bond, and all of a sudden interest rates go up to 5.5% based on the Fed's recent decision, well, you're still stuck at 5%. So as interest rates go up, they're going to have to lower the price of this bond to make it more attractive. The other side is also true. If interest rates go down, the bond is much more attractive now because you're still getting 5%, and now the market may only be paying 4 in general. So your bond is going to trade at a premium. That's in how that thing works. And there's a chart I'm going to show you. So look at here. This is a 5-year bond left to maturity. The price at $1,000 here is like right in the middle when the bond was initially released. Okay. And so as prices go up, let's say this 8% bond here offers an 8% yield to maturity. As the rates fluctuate, let's say the rates go to 9%. Well, now they're going to have to sell this at a discount because you could have gotten a bond that paying 9%. You're stuck at this 8% bond, and so they're going to have to make it more attractive by lowering the price of a bond. Likewise, when rates go down, you're making more money holding that bond, so it's more attractive. They're going to sell it at a premium. So there's an inverse relationship between bond prices and yield to maturity. And so this bond's going to sell at a discount. This bond's going to sell at a premium. This relationship is important to realize because it does fluctuate pretty regularly with changes in interest rates. And that's what causes bond prices to change. So, interest rate risk then is the risk that arises from this fluctuation in interest rates. You have to, you're really taking on risk when you buy a bond, and you have to be able to, realize that. And so, again, bond prices are inversely related to interest rates and very sensitive. And it also depends on, the longer the time to maturity. The longer the maturity time is, the more opportunity costs you have, locked up into this bond. It really fluctuates. If it's a long tail on it, or if it's a shorter period, it's not as sensitive, right? So it's lower the rate, the greater the interest rate risk. So let's take a look at that. Consider these two otherwise identical bonds. The long maturity bond here will have much more volatility to interest rates than the short maturity bond here. It's much more volatile as rates go higher or lower, it's going to react a lot worse because the money is locked up for a longer period of time, and therefore the issue of the bond has to make it more attractive. So this yield curve is something to pay attention to. There's a term structure, right? The term structure is the relationship between the investment term, which is the length of the investment, and the interest rate. That's the term structure. The yield curve plots where all these, prices fall out on a graph, and it tells us the market interest rate per year, based on the maturity level. Now, there's something called the risk-free interest rate or the risk-free rate. We'll be talking a lot more about that in the future, but the risk-free rate is pretty much considered that to be treasuries, and it's the interest rate in which money can be borrowed or lent without a risk over a given period. So U.S. Treasuries have been considered a pretty safe bet because they haven't defaulted on any of them in a year, knock on wood. And so because they've never defaulted, that's considered to be the risk-free rate. So, for example, maybe 1, 2, 3% is considered risk-free, whereas you could always invest money there and have no risk of losing your money. And so you kind of compare that with other investments where you definitely have interest rate risk here. So look at this term structure of risk-free interest rates. This is November 2006 to 2008. Um, so this is the term in years. This goes out 20 years, and then this is the interest rate. So notice how 2006 is paying 5%, 2007 is dropping down and moving up, and then look at 2008. That's when the market was kind of melting down a bit, and there's all kind of fluctuation going on. The rate increase may depend on inflation too. So right now we're dealing with that with inflation putting pressure on this market, and the difference between these rates. Notice the spread and the 10-year loan at 3.4 whatever, and then versus like 9.1% on 1 year. Huge spread here due to the uncertainty in the market, right? Um, no one no one knew what was going to happen, so the rates kind of varied wildly. Pretty steep curve here. So it's important for you to understand mainly that this term structure and that there is an inverse relationship between the length of time that rates go out is very sensitive, and interest rates, as rates go up, the price of the bonds typically go down, as shown in this curve here, and as rates as rates go down, then bond prices typically go up.